So the efficiency and sustainability of a business is very important to many groups of people. Who are this group of people? Those that have interest in the business. We call them stakeholders. But in accounting, we could call them what? Users of financial accounts. So what you do as a business, that's how you continue to run this business, that is sustainability. And how good are you running your business, that is efficiency. Do we understand this difference between efficiency and sustainability? Efficiency is how good you are running the business. Sustainability is for how long have you been doing the business. Do we get the difference here? Elias, are you here? Are you here? That's it. Great. So, how good you are running this business, how long have you been in this business, are important to some group of people. These people that have to monitor your efficiency and sustainability are what we call financial account users or users of financial accounts. Those group of people that are interested in your sustainability and efficiency are what we call users of financial accounts. Do we get users of financial accounts here? So you write that, please.
Liabilities that need to be repaid over a long period of time. Lenders look at assets to see whether they can be sold for cash if one day the businesses cannot repay the debt. Lenders look at non-current liabilities to assess whether the business already has too many debts to repay. The loan creditors will want to ensure that interest payments will be made promptly and that capital repayments on the loans will be made as agreed.
Thank you. For the long-term creditors, now we're talking about financial institutions. They give loans to businesses. Before they give you a loan, you want to be sure about your collateral. You want to be sure that you are credit worthy. You want to be sure that you'll be able to pay back the loan. And not only paying back the loan when it is due to pay, also being able to pay the interest because you will be charged with interest. Do you get what a loan is? A loan is a credit facility given to a customer that has to be repaid with interest. Do you get what I said? I'm going to write it anyway. A loan is a credit facility given to a customer that needs finance that has to be repaid by that customer with interest. That's what a loan is. I'm going to give you money. I'm borrowing you. As soon as you have to pay back the money and with interest. Maybe 5% of that money I'm giving to you. If I'm giving you 10,000, you have to pay 5% of 10,000. Do you understand what the loan is?
Like I'm taking 1,000 from you, and when I give back you,
Maybe pay 1,300. Do we understand? Is it clear? So let me quickly write owners, trade creditors, and long-term creditors, okay? You can write this.
What's that word say?
Okay.
That's
Present.
the
Physically.
This
Physically present.
This has even to tell
Either to sell or buy. Or buy. No, it's not correct.
Listen, can I ask you?
Sure.
Here, physically present.
Present. Present.
After present.
They.
Day.
They. Yeah. Thank you. Please stop right there. Please stop. Please stop. Thank you. So, I'm quickly going to do a recap of the class. We're talking about users of financial accounts. We're talking about users of financial accounts because we run a business. Financial accounts are not accounts that are internal, they are external. So, we need to prepare these accounts using accounting concepts and convention, using what the law says we should use. We must not lie about it. We must not forge it. We must not make it look good. It must be stated the way it is. And it has to have its own format. Why do we have to present it in the way the law wants us to present it? Because it is banned by law. It is required by law that every organization, every business must prepare a financial account. Do you get it? Except for a sole trader. Because a sole trader is just a one-man business. So it does not have, it is unlimited liability. It is not a limited liability company. So it does not need to prepare a financial account. Though the business will prepare it just for its own decision or just for its own ways of checking and balancing its own operation. But it does not need to present it to the public. Do you get it? So who are those that need financial accounts? Who are the users of financial accounts? The first one, the owners. When we talk about the owners, we cannot talk about financial accounts of the business without the owner of the business. Because the owner of the business would have invested into the business. Yes or no? Yes or no? So, because he has invested into the business, what does he want? He wants to see how effective the business is. And how can he check? Because he's not going to be there physically. He would have employed managers and directors. So the directors and managers would present what? The financial accounts. So if he or she would use it to decide either to continue the business or to stop the business, either to buy more shares or to sell the shares. This is why the owners of the business need the financial accounts to take decisions about continuation of the business or not, to know how effective and efficient and sustainable the business is. That is for owners. And I said, notice board, they are not physically present. They employ managers and directors to get the job done. So the directors only present them with the information and they take decisions about that. 2, trade creditors. These are the suppliers of other businesses They sell on credit to other businesses. They need the financial accounts to confirm the creditworthiness of the business. So if I'm going to be, who is a trade creditor? A business that sells on credit to other business. A supplier that sells on credit to you. So why do I need to know before I sell to you? Why do I need to check your financial accounts? I need to check if you are not having a lot of creditors. If you are not a debtor to a lot of businesses. Do you understand? So if I am safe, then I will be able to sell to you on credit. Is it clear?
Yes.
A credit means I'm buying now and to pay at a later time. Is it clear? The third one, long-term creditors. They give loans to the business. They need the financial accounts to confirm the business that the business will be able to pay back the loan when due with interest. So the long-term creditors, they are like the banks. They give when you need finance, they give to you. But before they give you the money, they want to be sure that you are not a high risk. High risk means you won't be able to pay back. Do you get high risk here? High risk means what? You don't have the financial capability. You don't have the credit ability to pay back. You can't pay back. Their money will be lost. They may lose their money. The banks. So if you are not considered as this, then they can give you the money. So they want to be sure that you are going to be able to pay back your loan with the interest. Do you understand long-term creditors? So they want to see your financial statement of financial position. They want to be sure that your assets are more than your liabilities.
Like
The things you have are more than the things you owe people. You owe other businesses. Because assets are those resources that belong to the business. Liabilities are those resources that we owe to other businesses, that belong to other businesses, but we are using them. What you own is your asset. What you owe is your liabilities. Do you understand what liabilities are now? Things you owe to other businesses or resources that you owe to other businesses are liabilities. Resources you own as a business are your assets. Resources that belong to the owner of the business, that is given to the business, is the capital. Do you understand the difference now? Capital is, I am the owner of the business, I'm giving this money to the business. That's why we say there is accounting conception, or concept and convention. Business entity. The owner of the business is separate from the business. They are not the same. I am the owner of the business, yes, but that is the business. The business is not me, I am not the business. So whatever I give to the business, it has to be capital. And whenever I take anything from the business, it has to be what? Drawings. Do you understand?
yes.
Is it clear? So the owners we talked about it, they need to be sure about how effective, efficient, sustainable their business is. Trade creditors, they want to be sure that you are creditworthy. They want to be sure that you don't have a lot of creditors to pay. Long-term creditors, they want to be sure that your assets are more than your liabilities. Do you have any question up to now?
Can you repeat the long term?
The long-term creditors are like the banks. They give you a loan, a long-term loan, that it has to be maybe for 1 year, 2 years, 3 years to pay back. But what do they want to be sure about? They want to be sure that you are not what? A high risk. And if you are a high risk, they can't give you money because you won't be able to pay back. They want to be sure that you have more assets than liabilities. If you have more assets than liabilities, then you will be considered as what? Low risk. But if your liabilities are more than your assets, you are what?
High risk.
High risk. Is it clear now?
Yes.
Are you sure?
Yes.
Alright, do you have any question up to now?